Hi, I'm Jimmy. In this video, we're going to look at how to value financial stocks. I'm talking stocks that are banks, regional banks, big banks, insurance companies, any companies that deal with money as their product. So if money is their product, like a bank, they give loans, they take deposits. If money is their product, we're going to look at the best way to value those companies. And then towards the end of this video, we're going to try to find some stocks that are undervalued using the appropriate valuation methods. Now, before we jump into that, I want to tell you real quick about a website that we built. We're going to be using this website throughout this video as to how to value different companies. So we built this investorsgrow.com to try to make it easier to value companies. That's the very point of it, to help us analyze charts, analyze the historical numbers, try to come up with what the best fair value is. You'll see that throughout this video. We also do 3 private live streams per week over in our private investing community. Again, if you'd like to join that or like to check out what we do, I will leave a link in the description below. Okay, now let's jump into the best way to value financial stocks. So the simplest way to value financial stocks is to use price to book value. You might have heard Warren Buffett talk about this many times in the past because Berkshire Hathaway, at least for a long time, was primarily an insurance company. An insurance company is a financial stock. And because of that, he used price to book value to value the company, or he used book value. He tracked book value to track how well the business was doing. Now, the reason that this is important is because the way book value is calculated is basically you take assets, you subtract liabilities. What is remaining is the company's book value. You take the price divided by that book value. Simple as that. Now, banks and insurance companies are a little bit different because money, cash, is their product. So something like discounted cash flow doesn't work at all for banks because banks take in cash. Let's say they take in deposits and they give out loans. Well, it throws the numbers off for cash flow, operating cash flow, things like that. So if you ever see a discounted cash flow calculation for a bank or for an insurance company, for anything that is classified as a financial stock, you're probably not likely to use that. So our number one method to value financial stocks is going to be to use price to book value. Another method, let's call it the secondary method, is to use price to earnings. Now, for anybody who's fairly new to investing, basically what price to earnings is it is your cost, the cost you're paying for every dollar of earnings. So let's pretend that a stock has a PE multiple of 20x. Well, a 20x PE multiple means you're paying $20 for every $1 of earnings. Of course, ideally, what we want to do is we want to pay less for every dollar of earnings. So you'd rather pay 10x than you would 30x. Why pay $30 for a dollar of earnings if you could pay $10 for a dollar of earnings? Now, that comes to how to actually apply this and how to make sure that we're not overpaying. What is a good PE multiple to use? Or even what's a good price to book value to use? Is it 10x, 20x, 2x? What's the best number? Well, for that, let's jump in and look at some individual examples of companies that could be undervalued right now and could be an interesting one for us to analyze. So first up, we got Wells Fargo. Now, this is a snapshot from investorsgrow.com. And you can see, first thing to notice here is that up here, because the website detects that it's a financial stock, well, the best valuation method to use is price to book value. And that's what we're using right here. And this chart of price to book value is Wells Fargo's price to book value going back the past 10 years. You can adjust this to look at 5 years, 10 years, 20 years, make whatever makes it easier for you to see the information that you're after. But here, what is the best valuation method to use? Well, we've got 3 different lines here. Well, we calculate 3 different averages that are used in the website: the 5-year, the 10-year, and the 20-year average. We can see in the case of Wells Fargo that both the 10 and 20-year averages put the fair value for this stock at about $66 per share. Meanwhile, the 5-year average puts the fair value at about $58 per share. Right now, the stock's trading at about 57, so that's about fairly valued. But if we believe that the longer-term average makes more sense, well, then perhaps this stock could be a bit undervalued. Now, the key to making sure that price to book value in this case, if you didn't know anything about analyzing price to book value companies, well, looking at this chart, we can see that the y-axis is a relatively small range. It runs from about 0.4 to slightly over 1.5. So we know that over the past 10 years, this stock is stuck in a fairly tight range. So ideally, we want to buy it on the lower end of the price range. Right now, the fair value is sitting below a few of those averages. So down here, we can see that the price to book value for Wells Fargo is currently about 1.1x. The 5-year average is sitting at about 0.9. Meanwhile, the 10-year average, we can tell that because both boxes are green, put this stock as slightly undervalued. So on the website, we calculate 3 different averages: the 5-year average, the 10-year average, and the 20-year average. Right now, the current price to book value for Wells Fargo stock is 1.1x. We can see that down here. The 5-year average has it at 0.9x, which means that if we want to use the 5-year average, well, this stock would be slightly overvalued. But if we wanted to use the 10-year average, we can see that it's also about 1.1x. Using 1.1x, we end up with a fair value of about $58 per share. Right now, the stock's currently trading at about $57 per share. Now, perhaps we believe a better way to value a stock like Wells Fargo is using the long-term average, 20-year average. Let's face it, they've had some hiccups in the past few years, so maybe sticking with the long-term average makes the most sense. Well, if that's the case, then the fair value would be about $65 per share using a price to book value of 1.3x. Now, what about if we want to use price to earnings? Well, clicking up here, we can go over to price to earnings, and we can see just like that, this stock looks mostly undervalued. Using the 5-year average, these are the price to earnings numbers up here. Using the 5-year average, the stock's about fairly valued, 57 and 58. We saw a very similar number over with price to book value, but the 10 and 20-year average have the averages being about 12x compared to the current 11x for earnings per share. Now, I think that this is crucially important because a lot of times people will look at the long-term history of the stock market and say, you know what, the stock market on average has averaged between, let's say, 19 and 20x when it comes to a PE multiple. Well, we might look at 11x for Wells Fargo and say, oh my God, that's a screaming buy. 11x, it should be 20x. Look at how good that is. But the advantage of using their own historical numbers is looking at this historical, we can see, well, it almost never gets anywhere near 20x. So why would we be okay with buying it at 20x? We can see that with this historical number, you'd be far better off buying it closer to 8 or 9x. That is what one of the powers of analyzing the company's own history instead of just taking broader averages. Now, given a choice between using price to book or price to earnings, I usually like to use price to book as my primary method, and then I'll use the secondary method would be something like price to earnings ratio. I think these are the two of the more reliable valuation methods to use. Now, you could use the other two that we have right here, which is enterprise value to revenue, enterprise value to sales, revenue and sales are the same thing, or enterprise value to EBITDA. We could do that, but because of how enterprise value is calculated, it could throw off the numbers for some financial stocks since enterprise value takes into account cash and debt. And as we already discussed, cash and debt are kind of their products. So it could end up throwing things off. I would stick with price to book value and price to earnings ratio, primarily price to book value. Now, what other companies do we have? So the next company that I think is an interesting one, jumping back to price to book value, is PNC Financial. So first thing we might notice here is one, the range for price to book value for PNC looks pretty good. On the low end, you're talking 0.8, 0.9. On the high end, about 1.6. And when we jump down here, we look at the price to book value calculations. Well, we can see using the 20-year average, it's about fairly valued. But both the 5 and the 10-year average indicate that this could be undervalued. Now, just looking at this chart, if we only bought when this stock, let's say, dropped below 0.9, we've done our analysis, we like the business, we want to buy it. Maybe it's in our bullpen of companies we're interested in owning. If we only buy this one when it gets below a reasonable fair value, a reasonable price to book multiple using their own historical averages, well, we're far better off to have bigger long-term gains when we buy the stock correctly. So in this case, I'd be looking for somewhere in the 0.9 range for it to be a really great buy. But right now, it looks slightly undervalued using price to book value. Well, what about when we jump over and use price to earnings? Well, we can see with price to earnings, it's gotten a bit more volatile recently, but still the range is going from about 5x to up to just short of 20x. So again, using their own historical averages, right now the stock looks slightly undervalued using all three averages. But again, I want to bring out the importance of not assigning, what we did in one with one company or one sector is not necessarily the same thing we should do over here. We cannot use this S&P 500's 20x average over the past 50 years for the price to earnings multiple when financial stocks are clearly different. We've looked at two already, and both their average is nowhere near 20x. So again, this one's slightly undervalued right now and could be an interesting one to try to do an analysis on and see if it's something we want to add to our bullpen. Okay, now we got another bank. This time we got a regional bank, and that is Citizens Financial Group. So this is a good company that has had a lot of activity lately. Regional banks have really gotten beaten up. In fact, if we look at the price to book value down here, well, the price to book value for all three averages looks slightly undervalued. This stock could be an interesting one to analyze today. So outside of the jump above 1x in 2017, and then the pullback during the financial crisis and really the whole banking issue that happened not too long ago, a couple of years ago, well, we can see that this stock is traded in a fairly tight price to book value range. Again, if we're interested in a bank, or perhaps if we own this bank, I'm assuming we are going to do much, much better if we buy this one at a low price to book value. Again, assuming we've done the research on the stock. What about when we jump over to the price to earnings multiple for this stock? Well, here, the stock doesn't quite look as undervalued as the other stocks did. It only looks undervalued, slightly undervalued, using the 11x of the 20-year average. But again, this is a secondary valuation method. Now, for me, if I'm looking at this one, I'd like to have both numbers kind of confirm it. I personally bought Citigroup, and Citigroup was undervalued from a PE multiple perspective and from a price to book value perspective. But I felt fairly confident jumping in and buying that once I had done my research. Now, in future videos, we're going to go through each of the 11 sectors and try to come up with what are the best ways to value it. I'm doing it based on my own experience, but I'm also going to as many analysts as we can from all the big investment banks and find the analysts that cover each sector and how do they value those companies? What are the best valuation methods? For example, to know that financial stocks price to book value works and discounted cash flow doesn't work, to just knowing that could prevent us from making very silly mistakes through our entire investment career. Now, if you'd like to get access to this website, and again, you get these notifications with many companies letting you know what valuation method is the best one to use, I will leave a link in the description below how to get access to this. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.